So the Reserve Bank has just raised interest rates, and here are 4 reasons why you need to stop panicking as a property investor about the rising interest rates in South Africa. Hi, my name is Yolanda and I'm a wealth advisor. On this platform, I give you easy, actionable tips, content and strategies that you can use to manage money well, to live abundantly and build generational wealth. And here's 4 reasons why you need to stop panicking about these interest rate hikes. And if you stay with me till the end, I have a bonus point for you as well. So if you've been watching the news, or if you have been trying to buy or sell a house, you know that the interest rates are pretty crazy right now. They've been on the rise since late last year and expected to continue increasing going into 2023 and hopefully cooling off in 2024. As it stands, the prime interest rate is 10.5%, and this is impacting the housing market, both buyers and sellers. And what the rise in interest rate has done is it pushed a lot of people out of the housing market due to affordability. And technically, less buyers means less competition. So over the past 2 years since lockdown, the Reserve Bank has dropped rates to try and stimulate spending. And during that time, buying property became a lot more affordable for a lot of people. And if you're somebody who's bought property due to the interest rate dropping, and that's the only reason that you had affordability, things might not be looking so rosy for you right now. We found really low prices, low interest rates, and that just stimulated the housing market in South Africa. Supply and demand was out of control in this crazy market. But now that interest rates are rising, it's sort of balancing things out to the pre-pandemic level. Higher interest rates reduce the number of buyers that can afford a home loan, thereby reducing the competition for homes. And these higher interest rates have 2 effects on the market. One, it prices buyers out of the market due to affordability, and this basically puts downward pressure on housing prices. Now, this depends on the area that you're in. Obviously, you might be in an outlying area where there's huge demand, and that could not apply to you. But usually this downward pressure is good for buyers. And while these rising interest rates outprice a lot of the market because it becomes unaffordable for many, another thing happens. Raising interest rates means that there is more inventory on the market. More houses are for sale, so you have a bigger variety for choice if you are purchasing. While certain segments, homes are selling really quickly, in other segments, houses are staying on the market for a little bit longer and often being reduced because now it becomes a buyer's market. Additional listings come on the market. Houses stay in the market for a lot longer because there are fewer buyers that have access to finance and there's a larger amount of inventory. The third thing is it creates a boom in the rental market. And because home loan payments are highly increased due to the interest rate, it makes rentals a little bit more affordable. And again, this is dependent on your area. So apparently there's 2 certainties in life. One is death and the other is taxes. And certainly one is more preferable to the other. Higher interest rates offer greater tax deductibility on investment property. Check out this video to start accessing finance for property. And lastly, your bonus point, rate increases are happening to try and curb inflation that has just been out of control. And because inflation rises, this basically inflates property prices, allowing you to draw additional equity out of your property if you need to. With the Fisher equation and repo being at around 10.5%, inflation being at 7.5%, the real rate of borrowing is just 3%.